To be frank, it really doesn't matter how much money you have to start with. The key is to just start. The problem is nobody really knows what is the lowest point in the market. How many people actually tell you, hey, this is the target price in this amount of time? Even if I put my money at the highest point into the S&P 500 before the crash, I'd still have 4 times my money today. How many of those analysts' targets were accurate? Hi, welcome back to another video. Today, we're going to be doing a Q&A where I'm going to answer some of the questions that you may have. Before I get into it, I'd like to thank you all for subscribing to my channel, for watching the videos, and for the comments. It really does help. Well, that's a great question. When I was younger, I always thought timing the market was the key. Buy low, sell high. This is something that, I was taught in business school. And in theory, sure, it works. But the problem is nobody really knows what is the lowest point in the market. And I think the second part of that question is more relevant, which is, time in the market. Why do I say that? I'm going to give you an example. If you take the S&P 500, before the great financial crisis in 2008, the S&P 500 was at an all-time high of 1,500 points. Then the crisis came and it went down to about 600 points, give or take here and there. That means a 60% drop. Today, the S&P 500 is around 6,000 points. What does that mean? Even if I put my money at the highest point into the S&P 500 before the crash, I'd still have 4 times my money today. Now, some of you may say, hey, Niranjan, you could have 10 times that amount of money if you found the bottom. I agree. But if I ask anyone today, hey, over a 17-year period, if you can make, or 18-year period, if you can make 4 times the amount of money that you invest in today, would you be happy? I'm sure most people would say, yes, I'll take that deal. I agree. 10 times is better than 4, but even 4 is pretty good. But the thing is, you're only going to get the 4 or the 10 if you're in the market invested for a period of time. So my belief is that time in the market is much more critical than market timing. If you haven't already done so, please hit the subscribe button. Like I mentioned earlier, I use 2 things. Number 1, I look at qualitative information. So let's say I want to buy a company. I read about it. I watch maybe some videos about it. I see what's going on, hear different opinions and views. Let's say I have a certain qualitative perspective on a certain company or a certain fund. Then I do some quantitative research. So of course, I'm looking at certain ratios, PE ratios, price to book ratios, and so on, but not just those. I'm also, of course, looking at numbers. If you're going to ask me, hey, Niranjan, are you looking at any sort of valuation models, dividend discount models, discounted cash flow models? The answer here is more no than yes. I used to do that earlier on in my career, but I realized a lot of those models, while I have a lot of respect for them, the conclusions that one can derive from those models is highly flawed. And I'll tell you why. There are a lot of analysts who use those models and they take a simple average of the prices they get from those models and they have a certain target price. I'm okay with that, but it doesn't work for me. Because how can you take a simple average of all of that? Or even if you take a weighted average, if a company is a growth company and doesn't pay much dividends, the dividend discount model is useless. So how would you weight the other models? It's very subjective because a simple average or a weighted average of these models, how do you make those decisions? So I'm personally not a big fan of that. The other thing I'm really critical about is if you watch a lot of news or these analysts, they give you target prices. How many people actually tell you, hey, this is the target price in this amount of time? Almost nobody. The other thing I'm critical of is how many companies or how many of us are actually doing analysis of how many of those analysts' targets were accurate. Again, I haven't seen many reports where they say, hey, firm ABC made these many claims for these many stocks that they would reach this target price, and they were correct this many times. So I really do question all that analysis. Again, I don't mean any due disrespect to anyone in the financial services industry, but I'm just telling you that for me, that doesn't work. I try and just think logically what's going to work for me. If I feel a company has growth potential, is it going to grow, or a fund, and then I try and invest in there. I'd like to at this point tell you that I'm not giving financial advice when I say this. This entire Q&A is purely for entertainment and educational purposes, so please keep that in mind. Let's break that question down into 2. If we first tackle the emotional part of it, If we look at the last few months, the market has been very volatile. It's been going up and down. Sometimes the market reacts abruptly just because somebody makes a certain statement. What I've come to the conclusion is rather than trying to be reactive, let's be proactive. What do I mean by that? There are certain companies, certain funds that I like, and I'm probably going to stay invested in them no matter what. So whenever there is extra volatility that impacts that fund or that stock, and let's assume that company doesn't do so well that day. Let's say the stock price goes down, I buy it. I guess what I'm trying to say is volatility really helps, especially if you're a long-term buyer. Because if that stock goes down, it's a great time to enter it. Where volatility is a problem from an emotional standpoint, especially, also from a financial standpoint, is let's say you're about to retire and you need money for your retirement. Then it can become quite a challenge because at that point, you're a bit worried, you're nervous, and you may not want to stay in the market. Imagine if the market drops 20%, you have 20% less for your retirement. So there's a bit of a challenge and emotionally can be quite drained. Now let's talk about the financial impact of market crashes. Once again, if you're a long-term investor, it shouldn't really matter because you can actually take advantage of the volatility and you can do very well. Let's take, for instance, the tariffs that have been imposed on certain countries by certain countries. This is a great opportunity to get into some really good companies and make money over the long term. I've made a video on tariffs and my views on tariffs and investments, and I'm putting the link here and you can watch that as well. But once again, from a financial perspective, I would not be investing in the short run to try and make money off volatility. Personally, that's not my strength. I'm sure there are some people who can do that and are pretty good at it, but that's not something I'm really going to get into. To be frank, it really doesn't matter how much money you have to start with. The key is to just start, irrespective of whether a person is 20 years old, 40 years old, or 50 years old. Sure, each of those persons has different time horizons, has a different personal situation, professional situation, family situation, etc. But the key is just start. It's better to start late than to never start. And even if you just have $100, start with something conservative, play around, get some confidence, get those dividends coming, and it'll motivate you. Once you start seeing that the dividends are paying for at least a part of your lifestyle, maybe for a short vacation somewhere, it motivates you to invest more and more. So the key again is just start. If there are any questions you'd like to ask me, please mention in the comments below. I'll be happy to do another Q&A at some point in the future.